Good afternoon and good evening. This is Financial Literacy 101. I'm your host, Ross World. And today we're going to be talking about capital gains tax. Capital gains tax. Now, a lot of times we hear capital gains tax referenced when it comes to investing. And a lot of people who are novice investor, beginning investors, sometimes people who invest for a while, they still don't understand capital gains and also what is capital gains tax. See, when you buy an investment, when you buy a security, same difference. You hold it for a day or 2 days or even for a year and it appreciates in value. So take for instance, you bought Apple. Let's just take Apple for example. And 2 days later it went up 5%. Okay, so it appreciated in value. So you have already endured a capital gains tax. Now, the only difference is you only apply that tax when you sell it. See, the key to investing is when you buy securities, aka when you buy stocks and shares, that you put these in tax advantage accounts. But whether you hold that stock for a day or for a year will depend on how much you're paying taxes. So again, capital gains and a capital gains tax is if I have a stock and it appreciates in value 1%, 2%, 3%, when you sell that stock, that is when your capital gains tax is applied. Now, if you don't sell it, this is simply capital gain because you actually profited off your investment. So that is a capital gain because we need to understand that the equation that they use is purchase price equals selling price equals capital gains. And some people even look at it backwards. Capital gains to selling price based upon the purchase price. You get what I'm saying? So that are what capital gains. Then for tax purposes, you have the difference between realized gains and unrealized gains. And a gain is not realized until the appreciated investment is sold. So that, again, it's the same difference. So realized gains is when you sell the investment and you have to endure a tax, if that makes sense at all. Okay, so we need to understand that when people are using a term that you don't know of, capital gains, because essentially a lot of things in investment, we as investors just don't, people, we're trying to teach them and we're talking in these capital gains and unrealized tax and, all these key words in the investment world where normal people are like, what is a capital gain? A capital gain is only amount appreciation from your security, from your investment. And a capital gains tax is only applied once you sell that investment, one is appreciated. Now, we haven't even got into capital gain losses and how you can actually file for that as well. But you do have short-term and long-term capital gains. Now, to qualify for capital gains, it is based upon how long you hold it. A long-term capital gain is held in a lower tax bracket when they're taxing capital gains if you hold that investment, if you hold that stock for more than a year. It has to be more than a year. See, day traders make a lot of money, but legally they pay a lot in taxes. So that is something they really have to watch because they're selling and buying investments all day long. And they are incurring capital gains. Now, they may be small, depending on how much investments that they're moving, but nonetheless, they are accruing capital gains. All right, there's another segment of how long you hold on to once you sell that appreciated value, or you receive that appreciated value back in money. How long did you hold it until you bought another security? So that's another time for another class. But take, for instance, you bought 100 shares at $20. Okay, you bought 100 shares of whatever stock at $20. How much is that? $2,000. Then you sold 100 shares at $50. How much is that? $5,000. The capital gain from that was $3,000. I'm going to say it again. You bought 100 shares at $20, which is $2,000. Then you sold, out of your 200 shares, you sold 100 shares but at $50. So your share investment appreciated, you doubled your money. Okay, so 100%, you doubled your money. So you sold half of those shares, which was 200. You sold 100 of them for $50 a share, which is $5,000. Your capital gains is $3,000 because off your $2,000 investment, you made $3,000. Now, the appreciation in your portfolio, if you didn't sell the amount, would simply be your capital gain, which would be $3,000. Now, the capital gains taxed. It is taxed at 15%. You take away $450 from your $3,000, and there you have it, ladies and gentlemen. The money you get back after they tax it is to $2,550. Okay, $2,550. All right. Now, today's capital gain rates are, depending on your income, is 10, 12, 22, 24, 32, 35, and 37%. Okay. Long-term capital gain rates are taxed differently, generally lower rates, okay? But the basic capital rates are 0%, 15%, and 20%, depending on the taxable income. The breakdown points for these rates are, man, it's too easy to explain capital gains. So I have this little chart up here. I'm gonna let you guys see my screen so you follow right along, okay? Let's look at this. All right, as you can see, it says macro capital gains, the individual income tax rate. And they got it from 1954 to 2018. Pretty good graph here. You got the max individual income tax rate. Then you got the max capital gains tax rate. And they're showing you all the way up here at 90% down to around 25%. How much does it equal out and how they meet right here. Okay. And how this has been, it was up at one point, trickled down, and now it's kind of leveling off about your taxes, okay? So, excuse me. We have to be very, very careful when people say they want to become a day trader. Understand the capital gains tax that you will incur because you didn't hold those investments for more than a year. So it's imperative that you understand taxes, right? You don't know how to do taxes, but it's very important for your wealth for you to understand taxes, because when you're making movements with your money, people are like, yeah, you know what I'm saying, man, I'm making moves, I'm investing, I'm doing this, that, and the other. Okay, understand that everything you do with your money that makes you money, the federal government is just like this. They're watching it. You know why? They're like, okay, you're profiting for being in this country. You're profiting for being an American. Guess what we want? We want some of that money. Everybody wants money for a particular reason. So the federal government want that money. Sometimes, the states want that money for roads, all this. They're like, you wasn't going to be successful. You wasn't going to be nothing if you did not live in this country. So they want that money, man. All right. Gains or collectibles such as artwork, stamp collections are taxed at a 28% rate. The same rate applies to the portion of gain of the sale of qualified small business stock that isn't included from tax, like Section 1202 stock. Now, capital gains on a principal residence are taxed differently from other real estate due to a special exclusion, okay? Due to a special exclusion, small business stock are excluded from certain taxes. Now, basically, the first $250,000, that's $250,000, of an individual profit on the sale of a home is excluded from their income for the year. One. As long as the seller has owned and lived in a home for 2 years or more, for married couples filing jointly, the exclusion is $500,000. All right. So let's break down this graph right here too. Let's look at this graph as well. I think I have everything in there. So we look up at the tax chart, say how to owe nothing, and here we are. Capital gains 101. Filing status, 0%. We got the columns here, 15%, 20%. And as we go down, you will see the different amount based upon how much you make will dictate how much you'll pay in capital gains tax. You get what I'm getting at here? So in the 0% category, you have single people, 39,000 up to, and this is zero, guys, started from zero up to $39,375. You pay 0%. Okay, the 3 levels of long-term capital gains tax for 2019. So this is very, very recent. Now, this is someone like myself. You know, if you're single, you're not married. That's what all that means. You're not married. You might have a girlfriend, boyfriend. Who cares, right? But talking about that money. You have $39,375, so you pay 0% in capital gains tax. Head of household, if you claim that on your taxes and you make up to $52,750, 0%. Married, filing jointly, and surviving spouse. Okay, that entity and surviving spouse. So you filing jointly, but your spouse is dead. Up to $78,750. That sounds kind of harsh, but your spouse is dead. Well, your spouse is no longer with us. Sorry, should have been a little easy. Married, filing separately. Okay, so married, filing separately, as you can tell, is you're filing as a single person, basically. All right, but you pay 0%, which is cool on your capital gains if you hold it longer than a year. Okay, longer than a year, it's a long-term capital gain. Shorter than a year is a short-term capital gain, and you pay higher in taxes. All right, 15% column. If you make $39,376 to $434,000. All right, the same for 15%. For head of household, married, filing jointly, and surviving spouse, and married, filing separately. All right, let's go to the largest tax category for long-term capital gains at 20%. If you make damn near $500,000 for both single and head of household, married, filing jointly, and surviving benefit, and if you're married, filing separately, look at the big change in that. Look at the big change in this, ladies and gentlemen. They do not act as though you are a single person. They're like, okay, you're doing something with taxes. We quite can't figure out, but we're not going to give you the same tax amount as a single person by themselves for over 434. They put these people in a lower income tax category based upon capital gains. Okay, so hopefully you understand what I'm essentially talking about. All right, moving along. So 5 ways to minimize your capital gain, so to speak. First and foremost, the number one way you can lower your taxes when it comes to capital gains, and again, capital gains is the appreciation of your stock. So if your stock goes up 1%, 2%, 3%, $1, $2, $100, that is considered a capital gain. A capital gain tax is a capital gain is taxed, and they call it a capital gains tax, when you sell that investment. Okay, when you sell that investment at a higher amount than what you paid for. So if you had the Google stock and you bought it at $1,000 and you sold it for $1,005 because it appreciated in value, so you made $5 on the investment, you're going to get taxed. Now, depending on the time you've had that stock, dictates the amount you will be taxed, and either falls into the short-term gain or the short-term gain category, or the long-term gain category. Okay, long gains, smaller brackets for taxes, so you pay less. Short-term gain, you pay more. Long-term, pay less. Short-term, pay more. So invest for the long term, over a year. Take advantage of tax-deferred retirement plans, okay, such as 401ks, 403bs, and your IRAs, okay? That is also a way where your money is appreciated in value in those tax-deferred accounts. Like me, I always love 401k. I always love IRAs and 401ks. Now, 401ks are usually done by a corporation. IRAs are usually done by the person. Nonetheless, you can get those Roth in the Roth category, and they can become pre-tax where they're taxed already. I don't like traditional IRAs and 401ks because they're post-tax, and you're going to pay taxes when you retire. I don't want to pay anything when I retire. The money I see is the money that I want, the money that I want to receive in my bank account. I just don't like traditional IRAs or traditional anything, because your money could be accumulating value. And the only way this actually works, ladies and gentlemen, is if someone like a Donald Trump or a business tycoon or someone who understands taxes, and they say, we're going to revamp the tax plan. We're going to reconstruct the tax plan. And you did a traditional accounts with your 401k and your IRA. So If they do some sort of tax break or tax deduction, then you may be more profitable than me who got pre-taxed because of that. But it's too far in between for you to even predict that. So I just go with the realization of the money I see in my account is the money I'm going to receive. Not based on what government does. Laws being passed, legislation is being done, bills, all this, craziness that happens in the government. I don't want to pay attention to that. I just want my money. That's just plain and simple, okay? All right, so we got, excuse me, invest for long term, take advantage of tax deferred accounts, okay? Use capital losses to offset gains. Yes, you can actually file with your capital losses to offset gains. You can actually claim for that. Number 4, watch your holding periods. Again, long term. Then pick your cost basis, okay? That's how a lot of times I love dealing in, let me just read my notes here. All right, when you acquire shares in the same company or mutual fund at a different times and a different price, you need to determine your cost basis. For the shares you sell, although investors typically use the first out, they call it FIFO, or I think I just call it FIFO. FIFO. First in, first out method to calculate cost basis. There are 4 other methods available. You have last in, first out, dollar value, average cost, and this is only for mutual fund, okay, shares. But anyway, at the end of the day, ladies and gentlemen, let's just do a quick review, and I'm going to read some of your notes. That a capital gain is the appreciation of your investments / your securities. Capital gains tax is applied when you sell that investment at a higher amount than what you bought it at, okay? And then that tax is applied in the short-term or long-term category based on how long you have had it. Simple. So I always tell people, whether you are investing for retirement, you're investing for, let's say, a yacht, a boat, a car, a truck, or maybe you're buying an apartment building or multiplex, duplex, fourplex, whatever, you're buying a business, invest for the long term, ladies and gentlemen, because if you're not an expert trader, and I just hear some people act like you can just go out and become a day trader and be successful. These day traders who really make money, they are really, really intelligent. They're really smart. And the only thing I would think that they do is look at stock news, looking at candlesticks, looking at analytics, looking at all sort of macros and data and analytical this, and they're just looking at numbers the entire day because they're looking at how can I beat the market? No one can predict that. No one can really beat the market, essentially. You can guess right sometimes, but if you're trying to beat the market all the time, let me tell you, ladies and gentlemen, you will probably eventually lose. Okay? That's why I like to put my money in index funds, real estate, ETFs. I don't like mutual funds because they have a lot of hidden fees, high yield savings, and you make some private investments like for loans, right? You got Prosper, you got Lending Home. There's another one out there. Prosper is the only one that I know is a crowdfunding loan service. But if you put a couple of $100s in one of their risky loans of someone with probably a bad credit score, you can make a lot of profit off of that. Believe me, I did it once because I had to do a video, and I'm the type of person, I want to practice what I preach. So I think I did a $500 investment and my return was like 25%, because crowdfunding loan platforms, one in itself is risky, but these people who are applying for these loans, these accounts are actually recorded on their credit report. So some of these are getting these risky loans in order to build back up their credit. And you, being the loaner, not the borrower, can actually make good money off of this. Okay, that was just a little tidbit of information. Let me read your notes. Nolan says, what's up, hosts and people? Well, thank you, Nolan, for joining us. Stephen Gardner, we were able to get capital gain rates on a rental we sold after holding for 20 months. It saved us quite a bit. Indeed, I bet it did, Stephen. If anyone's in the chat, if you want to say hi to Stephen Gardner, me and him will be doing an interview on Tuesday. We're still discussing, we're going to go live or we're going to record. We're leaning back and forth, but I'll put some information out for tomorrow. We might just want to record and do some editing later. We're going to talk about infinite banking. We're going to do interview. We're going to ask them some questions. Hopefully when this video posts, whether we do a live or recorded session, you guys have a lot of feedback. I'm gonna leave a lot of information. It's gonna be on my channel as well as Steven's channel. So either way, you can get the information and you can help yourselves out and do another branch of finances that can be very, very profitable, whether it be the appreciation or the capital gains, or it could be tax saving methods, okay? Tax saving methods. So I'm not gonna kill the nanny on this one. I'm not gonna let everybody know what's going on. I think I'm gonna leave that for me and Steven for Tuesday. Nonetheless, ladies and gentlemen, that is my time for today. Thank you for joining me. This is Financial Literacy 101. Learn money and be inspired. All right, guys, you have a wonderful day and a great evening. I'm out.